Dissecting the question, is the world on the verge of a new economic crisis? What is the role of certain banks? And how should the investor behave? Please allow me to welcome our moderator, Ms. Lubna Bouza, the head of business news at Sky News Arabia, joined by speaker Mr. Damien Bunce, the Chief Customer Officer at XMEX, along with Mr. Ahmed Najm, the head of research of the MENA region at Access.com, as well as Mr. Danny Salman, the senior market analyst at Multibank, along with Mr. Andrew Ashok, the CEO at Bellio, and last but not least, Mr. John Murillo, the Chief Dealing Officer at B2 Brokers. Everybody, please join me in welcoming them on stage with a huge round of applause.
So good morning, everyone, and thank you all for making the time. What a pleasure to be here. And thank you, Dr. Muhammad, for putting together such an awesome event. Good to see so many familiar faces in the audience, friends and colleagues, actually, from media and the financial sector. Thank you all for being here today. So let me ask you, what is the one question on everyone's mind nowadays? Noura mentioned it earlier. Is the world heading into a financial crisis? And here are some more. If so, how long it will last? And what do we do with our money? Do we invest or we park our money? And if we invest, where to invest and how? Without further ado, those are the questions that I will try to answer with my distinguished speakers here, who are rightly positioned to probably give us some good answers. Damien, thank you very much for joining us. Let me start with a simple, easy question.
Oh, yeah. It's going to be simple.
Is the world heading into a financial crisis, slowdown, recession, and why?
Okay, Lubna, thank you. And thank you all for listening early in the morning. Well, listen, you don't need to be a market strategist or an economist to unpack that question. You probably need to be a magician because, I mean, deep down, there are some major factors at play pretty much all at the same time. And so if you think, of course, we had an invasion that took place, last year, that plays out in the capital markets and continues to do so. Can't, of course, forget the expansion of NATO, with countries like Sweden and Finland taking place. Again, it plays out in capital markets. Everybody, and it doesn't take a genius to know that we have, had a crisis in pricing and inflation, in all parts of the world. So when we think about the ECB, the Bank of England, and the Fed, or the Bank of Japan, I mean, all of them involved in, heavy monetary policy issues now. You saw recent hiking of interest rates across the board. There's a further 15 meetings, in fact, this year, on interest rates, which, of course, is going to have an impact on the markets. And then not to mention, we're talking about de-dollarization. The Saudis mentioned that oil can potentially be paid for in yuan. That's, of course, it's not happened in 48 years. That will play out in the markets. And then I think probably the biggest, and of course, while Makram, our economist, will give great color on this tomorrow, is around the debt ceiling. And for those of you that are not familiar, the debt ceiling is the amount of money that the Americans can borrow in order to pay bills. And it's under debate in Congress now. A decision was supposed to be made in January. We're now filtering through to June. Janet Yellen and Biden and all the rest involved in Congress, are debating what to do about it. The US debt is currently over 31 trillion. I mean, it's enormous. And, if the US defaults on its debt, God forbid, it will be cataclysmic. I mean, you saw what happened to the Japanese yen when the Japanese yen weakened relative to the dollar because the dollar hikes to combat inflation. We had immense amounts of trading in yen that had a major impact on the economy. So when I go back to my original comment, I think you need to be a magician to work your way through what on earth is going to play out. But as far as capital markets, and I'm a trader, there's a massive amount of opportunity and potentially a massive amount of risk.
Thank you, Damien. Let me bring you in, Ahmed. Damien mentioned different reasons why he thinks that we're probably heading to a potential financial crisis. You've mentioned that ceiling, the dollarization, monetary policies by central banks. In your mind, what are the main factors that will probably contribute to such a crisis going forward?
I think the main factors in China's reopening and the economic shows a gradual recovery, especially in the numbers that shown in service sector and the enhanced in domestic demand that will lead China to a new record again in the upcoming period. Next one, I think in oil prices and OPEC steps regarding the supply cuts when the prices are too low and increase the supply when the prices are too high. Last but not least, in Eurozone performance under pressure of high interest rate and Ukraine war. And they had a good luck in last winter, yeah.
We both heard about the factors or probably the risks that we have today. I want you to tell me, how can you calculate those risks and how do you see them changing the investment landscape for investors today?
So in terms of risks, I'll just want to highlight some forces that have been impacting the global economy, and one is sticky inflation that everyone, most of us didn't expect to be that sticky, and a slowdown in growth. If we look at the recent U.S. inflation data, headline came in at 4.9%, so slightly below than expectation. And we look at the sticky part, core CPI, we saw a rise of 0.4% from the previous month and 5.5% increase year on year. And regarding the slowdown, I think, we already have projections that, for this year, global growth is going to, based on some forecasts, that global growth will drop from 3.4 to 2.9%, and more so with advanced economies like the US. So if you look at, growth as of, the first quarter of this year, we already saw signs of weakness coming from the US and Europe. Now, China, they had that increase of 4.5% year on year. However, that's primarily due to the China reopening and, after the zero COVID policy. However, it's still below its historical growth rate. So yeah, the slowdown is there. And if you look at the US Fed fund futures, they're starting to price in rate cuts in the second half of the year, which could be, that perceived, slowdown, economic weakness, and potentially tipping into, a recession. Question is how deep or when it will occur. But,
so on the Fed point, there is a lot of noise, or I would say discussion around the strategy or the decisions taken by the Fed. I was watching an interview for Elon Musk today in the morning, driving from Abu Dhabi here, and he actually raised that point. And when you see even Elon Musk raising that point, you start questioning if we have a serious risk when it comes to the way or the process the Fed is taking his decisions, meaning being so slow in raising interest rate and probably being too slow in cutting interest rate. Do you see that risk, and how do you calculate it when you talk to investors or traders?
I mean, we saw that risk from the Fed. At the beginning, they were highlighting that inflation was transitory, and now we see it as persistent. But I think we would want to see maybe generally more economic weakness in the U.S. and a weakening in the labor market. So if you look at the labor market now in the U.S., it's still, generally strong. And if you look at the last unemployment reading, came in at 3.4%, which is a multi-decade low. So I think we would want to see more weakness in the labor market and a slowdown in inflation.
Gentlemen mentioned too many risks and challenges, and one of those would be the banking sector. Again, there is a debate over the banking sector and whether they are at the probably the at a risk of collapse. So we had the crisis in Switzerland Credit Suisse and UBS, and now everyone is actually monitoring what's happening in the US. So do you think there is a banking crisis coming our way? And again, is that something that you talk to investors about, and you have to do a calculated risk when taking any positions today?
Of course, in such uncertain time, we can see so many investors hesitating. And of course, there is something to discuss. So we talk about 3 banks in US and one of the major banks in EU. That's why, of course, people have such vision to maybe, don't be that much decisive, don't take some higher risk and all. But I would say that there is never, there is a perfect time. So, like there are many possibilities, opportunities on the market every day. And I think this should be considered as an opportunity. So we don't take any special calculations in regards to that. Like we, stay focused on the market and take plus minus, same actions, just of course with more curiosity on what's happening every day. I think banks, they took measures already in regards to that. So central banks, especially of both countries, and more cash was developed, created and went to the market. That's why right now I think its situation is more stable actually.
Yeah, look, maybe I can just add to that. But I think the reality is that Silicon Valley Bank, many people have just not heard of the bank, frankly, until you see it in the front pages of the newspaper and you realize just how big it is. But its failure was primarily down to treasury mismanagement. Putting client cash in long-dated bonds when interest rates, were going up. So that was just poor management. When you think about the regional banks, it's not so much a contagion effect, but the reality is that if people get nervous about banks, they leave. And what do? Is they walk across and they go to the very big banks, like JP Morgan. And then the very big banks get even bigger. And of course, that creates a different type of risk in the system. So I don't believe we've got a banking financial crisis ahead of us, in spite of the fact that, we had 3 very, very large banks fail. But, what is more worrying is, investor confidence or uncertainty that could lead to a run on banks.
And it's interesting that you mentioned that it was poor management, not bad assets, which another thing, and they did it for so long, and it's something they probably could have managed not to risk if they have thought it through. John, I don't think we're painting a very colorful picture here. We're talking about risk. I'm sure there's always a strategy where you hedge against challenges, risks, whether it's macro, micro, name it. What do we do today? So to hedge against all those risks that the gentleman mentioned.
Essentially, the way I look at it, the current climate investment horizons and whatnot, there's a series of plays that many professional traders are undertaking. I think it's a time to assess your risk to the highest level ever, because what I hear from a previous statement here on the banking sector, what Damien and yourself have mentioned, I would like to add a topic before I respond to that so-called opportunity. It is very interesting that JP Morgan was the advisor of some of these failed banks that, ironically, now they came to the picture and purchased them 30 days later. Just food for thought. I think it's an irony within. What people really need to understand is what type of strategy you're getting yourself involved. And I'm a firm believer in a balanced portfolio. That's the key, to be well invested and diversified at the same time.
So diversification, good. Damien, it's a good point to start my next question. I know that when you look at investing, and we're talking about probably Forex, commodities, etc., name it, any asset class, you look at 2 main factors: growth and inflation.
And
inflation. Yep. So rising inflation, slow inflation, rising growth or slow growth, probably the 2 main factors that you have to look at before you put together a portfolio. I want to ask you here today, looking at all this landscape that we have, there's a lot of uncertainty, I have to say, and it's very challenging to probably find the right balanced portfolio. But if I ask you, if about the right balanced portfolio that will probably do well no matter what. What will it be? I know it's a difficult question, but let's try to answer it all of us together.
But let me unpack your little bit tricky question there. So I look at this, or my lens is the lens of a trader, okay? And a trader has a fairly short-term perspective versus an investor that you were referring to there. But obviously, an investor has a longer-term perspective, and an investor always needs to make sure they have a globally diversified portfolio. It's as simple as that. I am, unfortunately, personally, do not have a globally diversified portfolio. I'm heavily invested in tech stocks, which was scary as hell last year and getting a little bit better this year. What I would say in terms of opportunities, I think when we're navigating markets like we are now, risk management is what becomes really, really critical. And, obviously risk management techniques differ whether you're working in an institution and you can hedge, or whether you're, a retail trader and you're maybe interested in trading gold, or dollar yen, or whatever it may be. And the kind of things that you need to be thinking about in these markets to protect yourselves are, not, for example, over leveraging. Having too much leverage in a volatile market can lead to a stop out and total liquidation. So keep your leverage levels relatively low. Think about economic news. Okay, when economic news is being released, unless you have a strategy that is based on economic news, because you have conviction it's going to go long or short, probably best to steer clear of trading during economic news. The third thing really is around liquidity. I mean, foreign exchange operates in trading sessions. So in London at 10 p.m, the trading session starts. Liquidity is very low because really it's only Australia and New Zealand, followed by Japan. So you want to limit your trading to highly liquid periods. And then the other thing for any of you that trade in the audience, I don't know who you are, is it's a very small thing that makes a big difference. And that's to make sure you're setting stop losses and take profits. Because at any point in time, you can find yourself in profit and then markets revert, of course, running, a bigger loss than you actually want. So there are sort of some techniques to think through as you're navigating these markets.
I'm going to ask you another question. If you look at individuals, the way we trade, and one of them, when you make some money, you rush to sell and book your profit. And when you lose, you wait because you don't want really to lose that money. And you say, maybe it's going to change. Maybe I'll make some money. Maybe I'm not going to lose as much. What's the right balance?
Well, Lubna, before we met on stage, I know you invested in Alphabet and made a nice profit, by the way, over 3 months.
Thank you very much.
What you're talking about there, and of course at XNest we're so big, we have opportunity to data mine, hundreds of thousands of clients, and what we see, and again it's very specific to retail, and it's not suggesting that retail's uneducated, but retail trading versus institutional trading has some trends, and what we observe, and this is very true in retail trading, people, is emotions. And typically, if somebody is trading in, for example, gold, and they've gone long, and the market goes up, you get a dopamine hit that says, yes, I'm in money. And people tend to take their profits quite quickly. And similarly, if you see your asset going down, there's this sort of negative emotion that kicks in that says, I'm not going to close the position now because I've definitely lost money. I'm going to wait until it recovers. And so when we look across all of our clients overall, what we can say is a general observation that people, they take their profits too soon and they hold their losses for too long. And that's why many clients that trade using algorithms and proprietary trading models, and we have a lot of those clients as well, they tend to have a greater degree of success because they remove the emotional aspect from trading. Computers do that.
Yeah, I'll try to do that. Ahmed, if I ask you where to invest today?
Where to invest?
Where to invest today?
I think China will be the next destination because after the COVID and zero COVID policy, and after the government and laws in the market, they had a very low budget, and we have a very low prices, and most of shares under a fair value. So the prices there is very attractive.
Okay, thank you. I'm gonna play a little game with you, and
That's good.
we'll try to see if you can play along.
Okay.
Long or short?
Is there
You can pass.
no position?
Yeah. You can say pass if you don't want to answer. Dollar. Okay. Let's talk about the medium term, not short term. So not I'm not gonna be talking about the short term now or the long run. I'm gonna bring you in very soon, by the way. Okay. So dollar, euro, and dollar sterling pound, long or short?
So euro dollar, medium term, let's say long. Okay. That's essentially because I think there's still more dollar weakness coming in, but at the same time, we cannot overestimate the probability of a rate cut in the second half of this year. So, and sterling,
Sterling.
I'll pass.
Okay, gold.
Yeah.
I'm not gonna.
Gold?
It was so fast.
Gold's a good one.
It's a good one.
Yeah.
What is the level? You
Let's
think
say long term.
220
Huh?
to 2,000 to 100?
I'm not gonna give a
Fine.
target, but I'm just gonna say that I think the biggest short-term challenge for gold would be, again, the over-expectation of a Fed rate cut and the possibility that, we may need to keep a pause on interest rates.
Okay. Andrew, you're a CEO, so you probably won't answer those questions. You've got your team to answer those questions for you. But I'm going to ask you a general one. Where to invest today?
Yeah, so actually, we have 70+% of our clients that prefer gold as their main trading instrument. Now we were discussing gold, it's like the main here in Middle East especially. But of course, I'm the fond of maybe more classic instruments in terms of, being more careful in such times as indices. So I would prefer to say that it's also always a good time to keep some portfolio with indices. Because we talk about a lot of companies inside. So, in such uncertain times, there is a high probability of the unfortunate events to take place. It's better to, diversify the portfolio, I think, between gold, some of the indices. And then, of course, if people want to, have some scalping, then, of course, they can find it on any of the instrument, during the week. There are some periods on different, 5 minutes, a graphic, or 15 minutes they can, enjoy. But if we talk like serious, of course, it's some indices, it's gold, and that's it.
Okay, so we all agree on gold. Don, let me bring you on a different subject, technology. I think technology has really changed the face of trading as we know it. I want you to tell me more about the importance of good technology and how did it impact the trading sector.
First of all, the tech space. And essentially, the way I look at technology and prime brokerage services is that they have come a long way in creating the most efficient markets when it comes to FX that I have seen in the last 2 decades. My firm belief is that through technology in such service, we are seeing spread compression to levels never experienced before. I remember back in the early 2000s, we were quoting a client, or late 90s, 10, 15 pips on euro dollar. And today, you see on an aggregation model, 0.3, 0.2, 0.1 all day long. It's the dynamic of the, evolution we've seen over time. And that's also, it brings me another point that technology has improved drastically is algorithmic trading orders. This has played a major role into what we're seeing today. I also think that thanks to technology, we're seeing some of the best risk management tools at our disposal today. You have real-time margining engines. You have, example, limit management, in addition to VAR models that are running in real time. This is something that has truly led to a new era thanks to tech. And in addition, just one more point on this, I would think that technology has led to multi-dealer platforms. We have, like never before, seen a pretty significant amount of participants nowadays. And what that means to all of us in this industry is, A, you have to remember that this tool, this diversification you have, leads to better decision-making processes into running day-to-day operations. So tech has been a tremendous contributor from that side.
Thank you, Damien.
I mean, I agree with fully with the sentiment that John made, but I mean, maybe I can be slightly controversial here. But, you know, technology has, without a doubt, massively accelerated trading. I mean, look at trading volumes on a daily basis. In FX trades about 7.5 trillion, okay? About 1 trillion of that per day is traded by retail. I mean, these are huge, huge numbers. And in XNES alone, we roughly trade about 300 million orders per month, okay? The processing required to do that is immense. And so the controversial comment I'm going to make is that I think what technology has done is it's benefited the consumer no end. Right now, as a consumer, with an iPhone, or in fact any form of phone, you can trade pretty much any instrument anywhere in the world with leverage and act like a mini hedge fund manager. Okay, so big expensive contracts like gold and oil and power, as well as equities and indices, and the list goes on, are available to anybody today to trade on a phone. On the flip side, the brokerage community is struggling because keeping up with technology is a very expensive investment, not just in technology staff, which are well paid, but also in hardware, in support. Regulatory requirements have gone up substantially. And so what you're seeing is a mismatch, in fact, where the brokerage community is struggling to provide all these services to retail. And on the flip side, retail's saying, well, this is great, but it's not good enough. Now I want zero trading. I don't want to trade, I want commission-free trading. So we're at a very big point here in the industry. I'm going to talk about that in one of my speeches later on today. But we're at a big point in the industry here where technology has done a lot for the consumer, but it's really challenging the brokers to reevaluate how they make money.
Damien, one of the things that you monitor very closely, and among others, of course, commodities. If I ask you today, I'm not going to ask you the long or short, but I'm going to ask you what's the best buy in commodities today? What medium term? Best buys and commodities today, medium term.
Well, again, I'm not an investor. I'm a trader, and gold has always presented fantastic opportunity because it's impacted by everything. And with gold, you're not going to get maybe a 40% downturn, which you can get in stocks and you can get, in crypto. So, a 10% drawdown, was what happened when Lehman Brothers took place. But intraday, gold does move 0.5% here, 1% there. So it's an interesting, asset from a trader's perspective. One thing we haven't touched on is crypto. When we're thinking about the environment we're in today, which is, I would describe it as chaotic, and we talked a little bit about the debt ceiling earlier on, typically the equities market is considered to be a sort of a forerunner of good things happening. And you can kind of see a little bit of resurgence now in the stock market, particularly based on last year. So there's a sentiment out there that things are kind of feeling positive, but in a way it's a bit of a false sentiment given some of the debt issues we talked about earlier. So if I were thinking about where do I put some money, probably right now, I would put a bit in Bitcoin.
In
Bitcoin.
In Bitcoin. Danny, do you agree?
Yeah, I do agree.
Really?
In terms of Bitcoin, I think what's interesting, what we saw recently with Bitcoin is it acting similar to that of, gold. It's away from your traditional way of investing, and people are looking at it more as a safe haven. So what we saw during the regional banking crisis, that actually, I think that was one of the catalysts that actually, that drove Bitcoin prices up as well.
So you agree on Bitcoin. Andre?
I would agree with Damien. He just literally said whatever is in my mind in regards to gold. I think it's the main key if we talk about the midterm.
John?
I'm pretty bullish on cryptocurrencies in general, provided you select good projects, you understand them. There has to be a lot of research prior. So I'm just a believer in digital assets. That's just, we've been in this space for many years. We have a very good understanding of the mechanics. Of course, there's good apples and bad apples out there. This is also in any industry. As long as you can filter that out, it does provide investment opportunities. Again, as an investor, that's where you have to draw the line and understand your time horizon, of course.
Okay. Thank you, John. Thank you, gentlemen, very much for making the time. Let's hear a round of applause for our speakers today.